from home currently. And despite all the difficulties, there are also some positive sides, such as more flexibility at work and also the use of new technologies. I hope that you also manage to keep on seeing these positive sides too. And more importantly, I hope that all of you are safe and at good health. I will take the opportunity of this tax update to introduce you to some more management team member of our tax team here in Qatar. That's why the seminar, the tax content of this seminar will be presented by Priyanka, Uma, Seville, and Khalil. Imran and Abhishek will look at your questions and they will lead you through the Q&A session at the end. Today, we will look into how the GTA responded to COVID-19 here in Qatar, and also what effect COVID-19 had to the general tax environment in Qatar. In a second section, we will provide you with an update on the new executive regulations. Thereby, we will focus on tax exemptions, withholding tax and contract reporting, transfer pricing, and then we will also look into what effect the new rules have on contracts and company structures. At the end, there will be a possibility to ask questions. In this connection, I would like to mention that you will find the Q&A section at the right side of your screen. So please feel free to ask whatever questions you have during the session. As I mentioned before, Abhishek and Imran will review them and we will try to answer as many of them as we can. However, please stay as general as possible because it will be very hard for us to answer, specific questions to your cases. Also, please make sure that you address your questions to all panelists in order to ensure that we can see them and answer them correctly. At the end of our webinar, you will find a feedback form. So it would be great if you could take a couple of minutes to fill that in. It's the first time we have a webinar, and so it's important for us to learn and to become better every time, and also to see what topics you would be interested in for next time. Please also note that this session will be recorded. The recordings will be shared with you via email within the next couple of days. So how has the GTA here in Qatar responded to COVID-19? Qatar was interestingly one of the first countries who have announced a deferral of the deadline for corporate income tax payment and filing from 30th of April to 30th of June. And recently also the CRS and FATCA deadlines have been deferred. CRS from the 31st of July to 31st of August, and FATCA from 30th of September to 30th of November. As another tax-related measures, Qatar has foreseen an exemption for customs duty for around 900 basic food and medical items for 6 months, starting from the 23rd of March 2020. But we also have seen in the practice that it has become easier to get extensions for internal deadlines, such as deadlines for questions and more information asked on tax returns. However, it is important to mention that the deadlines for withholding tax and contract reporting remain unchanged. They have not been extended. The same applies to legal deadlines. So whenever you are in a proceeding, the deadlines for objections and appeals remain unchanged. It is also worthwhile mentioning that the GTA remained fully functional. They only switched to online online modus. So they also work partly from home, and only a couple of people are in the GTA. What does the COVID-19 situation mean for the general tax environment in Qatar? For those of you who have attended our previous tax updates, we have already discussed that the international OECD discussion around OECD led to an increased focus on taxes here in Qatar. First of all, the scope of taxes has been extended. We will come to that later in this session, but also new compliance requirements have been introduced, such as CRS, FATCA, country-by-country reporting, and now transfer pricing. The next steps will be the RIBA, the new tax platform, where we still think that there will be a movement after the deadline for the corporate tax filings done, so after June. The big question is what will happen with VAT here in Qatar. You might have seen in the news today that Saudi has decided to increase the VAT rate from 5% to 15%, which is just triple of the rate. And I personally think that this act will increase the pressure to other GCC countries to increase the rates as well, and also, of course, to Oman, Kuwait, and at the end also Qatar to move forward with the introduction of VAT. On the other hand side, sorry, can you go back? Yeah. On the other hand side, we see also an increased activity of the GTA. This was before COVID-19, and this has not stopped with COVID-19. So we still receive extensive information requests on tax returns filed, sometimes tax returns from years back. At the moment, especially in the finance sector, so a lot of banks and insurance companies, but also other companies. And assessments are still done. Field audits for the moment we don't see, but the rest remains unchanged. What also continues to be the case is that the tax authorities, they do not have enough time to really look in detail into the information provided, meaning that often they just release assessments without having properly reviewed the case. And once the assessment is done, often you're forced to do an objection, and from objection stage, because the cases are not treated in time, you're often forced to go into appeal. So what we see is really an increased shift of cases from the desk of the GTA to court, which is in our view very unfortunate, but this situation has even been increased due to COVID-19. Next slide, please. So let's come to the new executive regulation. As also discussed in the last tax update, there was a lot of discussion ongoing between the big four companies and the GTA because a lot of questions were not answered. It was possible to get clarification on some points. Others, unfortunately, remain still unclear, and the discussion needs to continue. So confirmed points were the following. It's clear now that the new executive regulation has to be applied for the full year 2019. An exception only is applicable for withholding tax, where the new rules will only be applicable after the 12th of December 2019. It is also clear now that exempt entities are required to prepare full tax returns. They need to calculate the taxable income or loss, which means an increased compliance burden for exempt entities. Provisions will only be allowed for banks and insurance companies, so only the ones who are explicitly stated in the law for bad debts. For all other companies, no provisions will be tax deductible. This also means that going forward, end of service benefit provisions will no longer be allowed, or respectively, they will only be allowed once the end of service benefits are paid out. On a slightly more positive note, the GTA has accepted the suggested simplified procedure on the tax depreciation. I think I will not go into more detail here, so I'm happy to answer, the specific questions later. And also, they agreed with us that on IFRS 16 there will be no special tax treatment, so taxes will follow the accounting treatment. So with that, I would like to hand over to Priyanka. She will lead us through the tax exemptions.
Thank you, Barbara. Good morning, everyone. So here, let's see what happens in the case of listed companies. Listed companies will remain exempt from tax even under the new law and regulation, but its subsidiaries, joint ventures, or any company that has listed entity as its shareholder should be taxable to the extent of non-Qatari shareholders in the listed entity. Here, the most important point to be noted is that listed entities are also required to prepare full tax return, as Barbara explained in the previous slide in the case of exempt entities. However, in the law, there is no specific provision for imposing penalty for submitting incomplete tax return, but the GTA will have the right to disregard incomplete return and ask the company to resubmit full tax return. Accordingly, GTA can also impose penalties for the delay in submitting the full tax return. So let's see the residency requirement. We understand that the residency test is mandatory requirement to establish the tax status in Qatar. This residency test is applicable on all individual shareholders, that is other GCC nationals as well as Qatari nationals. In this example, we can see Qatari individual holds 80% of Exco shares and other GCC national hold 20% of Exco share. So here, assuming other GCC national is not resident in Qatar, Exco will be taxable to the extent of his share. So here, Exco will be taxable to the extent of 20% of his taxable income. Let's understand indirect ownership. In this new executive regulation, GTA has introduced direct shareholding rule, where GTA abolished the concept of ultimate beneficiaries, which we were doing in the case of previous law and regulation. Now, if at second level, Qatari individuals are not the shareholder, then its share will become taxable. So let's see what happens in this example. In this example, as in the second level of here you can see at Exco is owned by Vico is owned by Qatari individual. Then Vico holds 80% of Zedco share, and there is a 20% held by another GCC national. So assuming that this GCC national is not resident in Qatar, so Zedco will become taxable to the extent of 20%, because at the second level of Zedco, there is a Qatari individual. But what happens in the case of Exco? It can become 100% taxable, because the second level of Exco, there is an entity Vico. So the Exco will become 100% taxable considering this direct shareholding requirement. Now let's understand what happens in the case of 100% Qatari ownership. We understand as per Article 410 of Income Tax Law, entity wholly owned by Qatari individual should be exempt from tax. Further, direct ownership rule under Article 211 of Executive Regulation only refers to Article 411 of Income Tax Law, which is about the mixed shareholding. But based on a recent discussion with the GTA, we understand that GTA intends to apply direct ownership rule even to the 100% Qatari-owned entities. So if we see in this example, Vico, which is a 100% Qatari-owned entity, holds 100% of ZCO share, and then ZCO owns 100% of XCO share. So if we see XCO has an ultimate beneficiary, which is Qatari national. But here, considering the direct ownership rule, XCO can be 100% taxable. So this is still, we need more clarification from the GTA. Now regarding the state ownership, the current law and regulation does not have any specific provision for tax treatment of shares owned by the state. So the GTA might apply direct ownership rule on the shares that is not directly held by the state and can become taxable in Qatar. Let's see in the case of indirect ownership of listed entity. As we have already discussed that the shares of listed entity in a company will be taxable to the extent of non-Qatari shareholders in a listed entity. Further, we also understand the concept of direct ownership rule too. So in this example, we can see a listed entity having 20% non-Qatari shareholder holds 100% of Vico's shares. Then Vico holds 100% of Exco share. So here, considering listed entity is at second level and not individual Qatari shareholder, Exco can be 100% taxable and not just to the extent of 20%. Thank you for listening. Now I'll hand over to Barbara.
Thank you, Priyanka. So as a short summary, the first three cases presented by Priyanka, they are clear. So we also feel like, the interpretation of the GTA is reflected in the law. We, however, disagree with the last two cases, and there the status is that all Big Fours together are approaching the tax authorities again and try to change their mind, basically. So let's come to withholding tax. Khalil, what did happen? Are there any updates there?
Thank you, Barbara. Good morning, everyone. So today I will be presenting some updates related to two topics. First topic will be withholding tax, and second topic will be contract reporting. So let's start by withholding tax. It is important to remind that the scope of withholding tax has been extended under the new executive regulation. So prior to December 2019, date of issuance of the executive regulations, the withholding tax applicability was determined based solely on the place of performance of services. In fact, services that were totally provided outside Qatar were systematically not subject to withholding tax. Now, the new executive regulations introduces the concepts of consumption, usage, and exploitation of services in the state. Therefore, even if a service is totally provided outside Qatar, if it is consumed, used, and exploited in Qatar or by the company, the Qatari entity, it will be subject to withholding tax. So at this stage, it is legitimate to ask the question, what is the exact meaning of consumption, usage, and exploitation? So we would like to stress the fact that these concepts have not been defined in the law. There are ongoing discussions with the General Tax Authority to clarify the exact meaning of this criteria. However, It is our understanding that consumption is generally interpreted by the GTA as an expense which has been incurred by a Qatari entity for its benefit, means that the service really benefits to the Qatari entity. So if we take this definition and rely on this definition, you will agree that majority of services are likely to become subject to withholding tax in Qatar. As you can see in the illustrative example, we have here a company ABC incorporated in Qatar, which made payment to Exco located outside Qatar, UK for example, in counterpart of legal advice. So under the previous law, this service should not be subject to withholding tax as the legal advice was provided outside Qatar. However, under the new executive regulations, this service shall be subject to withholding tax as the legal advice really benefits to the Qatari entity and is accordingly exploited by EBC Co in Qatar. Okay, so hope this was clear for everyone. Let's move now to possible exemptions from withholding tax. There are two main categories of payments which are exempted from withholding tax. We have interest payments, and under this category we find interest on deposit at banks, interest on loans with banks, financial institutions, interest on bonds, securities issued by the state, and finally, interest paid by a permanent establishment in Qatar to its head office outside Qatar. We have also other payments which are exempt from withholding tax, namely reinsurance. We have also freight and sale of tickets and sea transport of petroleum and components of manufactured sub-products. So regarding freight, we would like to emphasize that this has not been defined in the law, and it is not fully clear if the word freight covers all the transport means, namely via road, air, and sea. However, it is our interpretation that freight shall cover all types of transport. In other hand, we would like also to note that the law has been silent on whether handling fees, port charges, custom duties paid abroad, and other services effectively connected with transport, if they shall be considered as freight and then exempted from withholding tax. So we are currently discussing with GTA regarding these 2 points, and we will keep you updated very soon. Okay, all right, then let's move now to another slide where we provide some updates regarding withholding tax refund. First, it is important to remind that the pay and reclaim mechanism has not changed. What does it mean? This means that even if an exemption is available under an applicable double tax treaty, the withholding tax still needs to be paid first, and then the non-resident supplier needs to appoint a tax agent, KPMG for example, to request the refund from GTA in Qatar. The only exception when withholding tax will not be deducted is when it can be clearly proven that services are not consumed, used, or exploited in Qatar. Okay, so also, as you already know, the GTA has recently issued a specific form to be used for withholding tax refund purposes. So there are two cases where the refund is possible, as you can see in the illustrative example. First case is our payments made to companies having a valid tax card in Qatar. Second case are withholding tax payments made to GTA, while a double tax treaty provided for a reduced or nil rate. Please be reminded as well that there are certain documents that need to be attached along with the refund application. So you can refer to the application form issued by the GTA where those documents are listed. Okay, perfect. Hope this was helpful. So in the following slide, we try to summarize the main actions required from taxpayers further to the new changes in withholding tax rules. First important action is to review the contracts, assess the withholding tax impact, and identify which transaction will fall or not fall under the consumption test. Also, in case of mixed contracts, we insist on the fact that a clear separation needs to be done between goods and services. Otherwise, there is a big risk that the whole contract value could become subject to withholding tax. This is also applicable when invoicing. It is applicable to invoices as well, which need to show a clear bifurcation between goods and services. Second action is also important to identify the complex transactions where it is difficult to apply the consumption and explore the possibility of requesting a ruling from GTA to obtain certainty. And we, as KPMG, can assist with this model. Third action, it is crucial to review the long outstanding payables balances older than 12 months in the balance sheet and regularize the situation to avoid any late penalty. Okay, so we are done with withholding tax. Let's move now to the second topic, which is contract reporting. So as a quick reminder, contract reporting is only required for suppliers contracts. Contracts with clients are not required to be reported. Please note that there is no value threshold for reporting contracts concluded with non-residents. However, for contracts with resident suppliers, the threshold is defined in the law. Please note as well that failure to report contracts is subject to 10,000 Qatari riyal per contract. This is one of the main additions of the executive regulations regarding this matter, contract reporting, as this has been clarified now that the penalty of 10,000 Qatari riyal is per contract. Finally, we have gathered some points with regards to contract reporting. Can you please move to yeah. So we suggest to report monthly or bi-monthly, depending on the frequency of the contract entered into during a month. Also, all contracts, we insist on the fact that all contracts which were active during financial year 2019 need to be reported, including new contracts entered into during 2019. So it's not only contracts starting from the date of December 2019, but all contracts that were active during the year 2019. We insist on this point. Also, please be aware that where there is no contract, purchase orders need to be reported. Third point of attention is that there must be a coordination with the IT team to ensure that contract reporting templates can be extracted from the system. Thank you.
Thank you, Khalil. I have already seen that we have already received some questions on transfer pricing, so I think everybody will be keen to learn more, especially when will now the first filings have to be done, Uma.
Thank you, Barbara. Good morning, everyone. Let's now just have a quick look at the main aspects around the transfer pricing regulations, and also see what kind of challenges we will have. But before that, let's just touch upon what have been the developments around transfer pricing in Qatar over the last couple of years. To begin with, in 2018, the country-by-country reporting was first introduced in Qatar. This reporting was applicable or is applicable for multinational enterprises groups where the parent company is a resident in Qatar and where the total group revenue is at least 3 billion Qatari riyal. If these requirements are met, then the CBCR reporting is to be done every year. The first year for which it was applicable was 31st December 2018, and the due date of filing of this report was 31st December 2019. So now when we look at December 2019, while the first CBCR filing deadline was already approaching, the new executive regulations were issued, whereby the new TP obligations were introduced in Qatar. As we stand today and based on the information that is available today, it is most likely that these TP obligations will be effective for the year 2020, that is for the filing and reporting to be done in the year 2021. Now let's have a look at the main aspects of the TP requirements. So the TP compliance and the work around it would basically start with first understanding what are the requirements and understanding what is the scope of these requirements on the company, identifying what are the transactions with the related entities. So when we say related entities, it means the related parties that are reported as such in the financial statements. And then that means that the transfer pricing requirements are not restricted just to cross-border transactions, but could also apply to domestic transactions. You will also have to see if you have transactions with jurisdictions that are will be specifically listed by the GTA as jurisdictions to be considered for the purpose of transfer pricing requirements and regulations. So once you have identified your related party or controlled transactions, the regulations require the taxpayer to do a detailed functional analysis and a comparability analysis around these transactions. So comparability analysis can be done once in 3 years. However, the data therein has to be updated every year. Also, you will have to do a high-level functional analysis every year to ensure that the circumstances around the transactions have not changed. So the outcome of this analysis and the analysis itself will be reported and explained through the prescribed transfer pricing documentation. To start with is the transfer pricing declaration. This is a declaration that will have to be filed annually by the taxpayer along with the tax return. And in the declaration, the taxpayer will have to confirm its compliance with the transfer pricing requirements or otherwise. After the declaration comes the master file, which provides a blueprint of the entire group. So it will explain the group's business structure, business policies. It will explain what are the value chains within the group, the supply chains, where do the main assets and intangibles lie within the group, and so on and so forth. The next would be the local file. The local file is more focused on the local entity here in Qatar, on the taxpayer, and the related party transactions entered by that taxpayer. It will document the functional analysis and a comparability analysis around the transaction, and also will provide the outcome and the arm's length pricing of this transaction. All this analysis all these three aspects will help the taxpayer to comply with its TP requirements. But the story doesn't end there. The analysis will always be subject to scrutiny at the time of tax assessments or transfer pricing assessments. But if the taxpayer does have robust documentation in place, if he does have effective transfer pricing policies implemented, it is possible to shift the burden of proof a bit on the tax authorities to be able to challenge the existing documentation and analysis done by the taxpayer. It's important to note that this is not going to be easy, especially in the first year of implementation, and you will have roadblocks, you will have challenges that will be upon you when you're doing your analysis. And talking about challenges, let's look at the main challenge that we all are facing today. That's COVID-19. We are already seeing the huge impact that COVID-19 is having on companies, the impact it is having on their cash flows and their profitability, and also eventually on their pricing. While we expect that the transfer pricing regulations will be first applicable for the year 2020, it's important to note that your first transfer pricing analysis will also have the impact of COVID on it. So your margins are also already impacted by COVID. And then it becomes important to identify what would be the right way of doing your comparability analysis when you're doing your transfer pricing documentation, especially in cases where you're going to have to rely on external comparables, where you will not typically have data for 2020, and you may have to rely on data pre-COVID, that is probably from the years 2017 to 2019. Then in essence, that data is not going to be comparable to your situation in 2020. So we'll have to start seeing where and how uh, can you make reliable and reasonable adjustments while doing your benchmarking analysis? Can you identify idle costs and set it aside when you're looking at your transfer pricing analysis? Can you can you do a gap analysis and identify what kind of revenues were lost due to COVID and whether adjustments can be made for that? Mm. With this kind of situation in front of us, we are seeing a lot of companies and groups revisiting their value chain, their supply chains, revisiting their pricing policies. But it's important that while doing so, there is a not just a short term and a medium term, but also a long term view kept in perspective, because having an overly fluctuating pricing policy or overly fluctuating transfer pricing analysis will not sustain in the long run. So with the kind of challenges that we have, I would want to sum up my discussions highlighting what should be the immediate actions that we should be taking. So as of today, we do wait for the detailed transfer pricing guidelines to be issued. We are waiting for the thresholds to be announced. But having said that, I think it is still important to see what is the probability of the transfer pricing regulations to apply to each of the companies, and start already looking at what are the related party transactions, uh, what kind of special jurisdictions do we have with whom we may have transactions, what is the quantum of those transactions and materiality, start collating the underlying agreements on those transactions, review the contractual terms, review the nature of the property and the service being offered or being consumed, and the pricing basis of it, and see how it reads with how it aligns with the contractual terms. It would be a good time to already start looking at what kind of group documentation is available. So, what kind of TP policies are there within the group, whether there is a master file being prepared by the principal entity, and whether this information can be collated. You would also want to look at transfer pricing studies and analysis done by other entities within the group that are similar to your entity here in Qatar, and start collating so that you are able to align your analysis and your story with what has been done within the group. It's also time to do your initial assessment to see if you have third-party transactions that you can comfortably say that are comparable to your related party transactions, and whether you could use that for your TP analysis. If not, you're going to have to look at external benchmarking. And with external benchmarking, it is important that you already start scoping your work and initiating your assessments and analysis, because you will need this time to do the required adjustments, identify what adjustments need to be done, identify what kind of corrective measures need to be taken, and if possible, make adjustments to your year-end year-end reporting or year-end results before you close your books of accounts for the year 31st December 2020. With that and with that thought, I would like to hand over back to Barbara.
Thank you very much, Huma. So for me, it's very clear, regarding the discussion we had throughout this webcast, tax is no longer be handled only by the finance department. So it definitely has an impact on contracts and maybe even on the structure of an entity. So maybe Sevil, can I hand over to you?
Thank you, Barbara, and good morning, everyone. I would like to briefly mention the effects of the change in tax regulation on contracts and corporate structures of the companies. I will discuss key considerations from tax exemption, withholding tax, and transfer pricing perspective. For tax exemptions, we already mentioned that although listed entities in Qatar are exempt from tax, their subsidiaries are now taxable to the extent non-Qatari shareholding in the relevant listed entity. We also mentioned that Qatari companies are exempt from tax as long as they are directly owned by Qatari nationals. So all those provisions show us that the shareholding structure is important from tax perspective. I believe those provisions would lead the companies to reconsider their structure. The companies need to check whether their current corporate structure is the best fit for tax efficiencies and whether any disposals to third parties, any intra-group share transfers or mergers are needed to reduce the tax cost. So we expect increase in corporate restructuring deals in Qatar. This was about tax exemption. For withholding tax, the parties need to decide which party will bear the tax liability, whether the parties will share it, and whether the tax amount will be deducted from the payments to be made in line with the contract. So the parties need to decide on those, and they need to include a tax clause in their contracts accordingly. But for existing contracts with no tax clause, I believe it's worth to review whether there is any change in law clause in their contracts. So the parties need to check whether change in tax regulation would fall within the scope of the change in law clause in their contracts, and how the risk arising from change in law is allocated between the parties, especially with regard to the increasing cost of transactions contemplated by the relevant agreement. So for withholding tax, the tax clause and the change in law clause is important in contracts. Apart from that, contract reporting requirements and transfer pricing issues would also lead the companies to draft their contracts more carefully. We already mentioned that the parties should execute contracts for their all intergroup transactions in line with the arm's length principle. So transfer pricing is a tax issue, but it's also supplement to corporate governance rules applied to companies. So complying with corporate governance rules would actually help the companies to comply with transfer pricing rules. And from that perspective, mere existence of contracts is not enough. The companies should actually follow their contracts, and the contract and the reality on how the arrangement is actually managed and operated should be consistent with each other. So we said that the companies should follow their contract. From that perspective, it's important to have legal certainty and legal consistency in the contract. Formal requirements should be met to make sure that the contract is legally binding on the parties. A clear description on scope of services, pricing matters, and clear clauses on governing law, termination rights, and liability issues should all be inserted in the contract. So those are a few key considerations. I believe that all those key considerations show us that tax issues, legal issues, corporate governance rules, they are all linked to each other. So they should all be taken into consideration together while making business decisions and documenting them. So the contracts and the arrangements should be reviewed by both tax and legal professionals, and simply paying attention to business-related provisions in the contract is not enough. So all of these show us that corporate secretarial work in companies is actually very important. and I believe it will be even more important in this new era to be shaped in line with the new tax regulation. Thank you.
Thanks a lot for this. Thank you, Sevil.
Thank you.
I see that we have received lots of questions, which is really great. So let me hand over to Imran and Abhishek to try to cover all of the questions.
Hello, good morning, everyone. We have, as Barbara mentioned, we have received a lot of questions. So probably we can start with one question which was raised about Qatari entities, that if the entities are exempt from tax and their share capital is below 2 million or their annual revenue is below 10 million, so whether this circular 4, which was applicable previously, is still applicable. So maybe I can ask Barbara if you can clarify on this.
Yes, I can confirm that it's still applicable, so this remains unchanged.
Yeah, and also a related question was about that, Barbara, that if the shareholder of that particular entity is a GCC national, so which may not be resident in Qatar. So previously it was understood that those companies were exempt from tax, but now the shareholder, the GCC national, needs to meet a residency requirement. So whether Circular 4 will still be applicable, like will not be required to file return, or will still be required to file return and pay corporate income tax.
You're asking me, sorry, Imran.
Yes.
Yes, so it is, you know, the circular remains applicable, so this exception remains the same.
Yeah, the other point, I can clarify that if the GCC nationals are the shareholder of that particular entity, but their income, their capital is below 10 million and revenue is below 10 million, but they are taxable now, if, for example, because the GCC national is no longer resident in Qatar, and the residency requirement, which Priyanka has mentioned, has clarified that it needs to meet that criteria in order to be exempted. So our understanding is that in that case, this circular will not be applicable because the company now becomes taxable entity. So that was one question. So the other question was about contract reporting. There are actually a lot of questions about contract reporting. So the question was, when contract reporting is applicable, what is the mode of submission, when we should start preparing the contract reporting, and whether it should be monthly or twice a month. So maybe I can ask, and also whether the supply of goods and construction contracts also needs to be reported. So Khalil, if you can highlight on those points.
Yes, sure. So first, it is important to remind that the deadline to notify the contract and to submit the contract to GTA is 30 days from the date of signing of the contract. So now, regarding the frequency of reporting to GTA, it depends on every taxpayer. So it depends on the frequency as well on the frequency of it entering into contract. So it can be, you can report bi-monthly or monthly. So anyway, it depends on every taxpayer. Then the second question you asked is about supply of goods, right? So
yes, right.
Yeah. So about supply of goods here, I confirm that the contract reporting is both applicable to supply of services and supply of goods. So it is not only for services, because sometimes it can be confusing that it's only for services and for withholding tax purposes, but it's not the case. It's as well for goods.
Yeah, so supply of goods needs to be reported as well. And there are some thresholds as well, yeah? I understand.
Yes, there are some thresholds, and they are defined in the law. There are thresholds of 200,000 contract value with the resident, and there is another threshold of 500,000 Qatari. So it is defined. The threshold is defined in the law, but however, the resident, there is no threshold value for reporting contract.
Yeah.
And I
now
think
maybe
let me just maybe Imran, just shortly on contract reporting. So the background of contract reporting is, of course, the tax authorities want, on one hand side, they want to see that you are compliant with withholding tax. However, it goes beyond that, because you see that also, local contracts have to be reported. So there the tax authorities want to see that your counterpart has actually a tax card and that they are compliant with the law. So this is probably the background of that, and that's why the scope of contract reporting is broader than withholding tax.
Yeah. Now maybe I can ask Abhishek to ask some further question which we received from our audience.
Yeah, hi, thank you, Imran. Hi, this is Abhishek, Senior Manager Tax. Actually, as Priyanka mentioned that based on the new rules, the subsidiaries and associate of the listed companies are now taxable. So there was a question from the audience that how to determine the non-Qatari shareholding in the listed company for the purpose of tax computation. So Priyanka, if you could answer that question.
Thanks, Abhishek. So here in this case, we'll see the details from Qatar Stock Exchange. So whatever is the non-Qatari shareholding in that particular entity as on 31st December, so that percentage will take for calculating the tax amount.
Okay. Yeah, thanks, Priyanka. And there was another question as you all may aware that the tax filing deadline has been extended by GTA. So there was a question on that whether does it apply on the payment of tax liability as well. So that I can confirm that yes, the 2 months extension is not only for the tax filing deadline, is it for the payment of tax liability as well. Let's move on to the transfer pricing. I've seen there are a lot of questions on the transfer pricing. So Uma, I have a couple of questions which I would like you to answer. The question is that is there any TP filing requirement for this year, or is there any confirmed communication from the GTAs as to what financial accounting year TP requirement will be applicable? So if you could throw some light on this.
So to answer the first question, as of today, we are still waiting for the detailed TP guidelines. Even for the TP declaration, we still do not have the format or the underlying rules around it. So it is quite unlikely that it will be issued so soon and will be applicable for 2019, which is due next month. So what we do expect is that what we do here is that the guidelines are expected to come within the next month or so, and should then have the first filing obligation for 2020. There is still no official communication, but this is what we hear, that the guidelines will be issued in the next month or in the next 2 months, and then it should be definitely then applicable for 2020.
Okay, thank you, Uma. There's a question on the contract reporting as well. That so as we understood that now it's the contract reporting is mandatory and it's within 30 days you need to report. There is a question that in the absence of a contract, so some of the companies they don't have a signed contract. What they have is a purchase order or just the proposal or something like that. So Khalil, the question is, do they have to report the signed PO if they don't have a signed contract for a particular engagement?
Yes, this is a good question indeed. So in fact, in case of absence of contract, yes, I confirm that purchase orders need to be reported.
Okay, thank you very much. Uma, just one question. I have one more on the TP that as we know that the new regulation, they have introduced the thin capitalization rules for the deductibility of interest. So could you please throw some light on the purpose and objective of the thin cap provisions?
Thank you, Abhishek. So the thin cap regulations are also somewhere driven by transfer pricing principles, where the tax authorities or the regulations do not, they want to limit the level of interest deduction that you would take in your tax returns. So they want to put a limit of excessive interest deduction and ensure that the funds are mainly, or sufficient capital is first there in place before you could take this excessive interest deduction. So the thin capitalization rules that are there currently is that the related party loans can at the most be 3 times of the ownership rights. And when we say ownership rights, it would mean equity. So your share capital plus reserves and accumulated profits, etc. So the maximum you could have, maximum related party loans you could have is 3 times of the equity, and anything above that, the corresponding interest on the loan above that would then be disallowed in the tax returns.
Thank you very much, Uma. And I think it's very important for the taxpayer and companies in Qatar to review the loan agreements and the interest which they are paying to the related parties. With this, I will hand over to Imran if you have any further question to ask.
Yeah, we received questions on withholding tax. One of the question is that withholding tax applicability on online services, such as various subscription, LinkedIn, Bloomberg, IBFT, etc. Whether those will be subject to withholding tax, especially keeping in mind that the taxpayers often don't have the ability to withhold tax, rather they have to bear that tax. So Khalil, can you answer that, whether under the consumption rules, these online services will now be subject to withholding tax? Are there any relaxation available under the Qatar tax law regulation or any further instructions issued by the GTA?
Yes.
Hello?
Yes, I think that for this kind of services, online services, it is not yet 100% clear on the withholding. The withholding tax treatment is not 100% clear. So I believe that it is better than we request a ruling from the General Tax Authority, than every taxpayer requests a ruling from the General Tax Authority, because I believe that it's case by case.
Yeah. Barbara, if you can also highlight on the same question about the withholding tax on online services.
Yes, maybe I can come in. So at the moment, it's the position of the tax authorities that everything which is basically paid by a Qatar entity, every service from abroad, is actually subject to withholding tax. So I would say at the moment, the tax authorities is of the opinion that withholding tax would be due on such services. In some specific cases, there is a question whether it is really a service or whether you could argue it's a product. You know, this is especially with shelf-ready software products. I agree with Khalil, there it's not really clear. However, on normal, you know, like Bloomberg or all this kind of subscriptions, I would say the position is quite clear that withholding tax has to be deducted.
Yeah, thank you, Barbara. Priyanka, I have received a question for you about indirect Qatari shareholding. What we understood from your presentation, that now the indirect Qatari shareholding will become taxable. So can you share some views that whether the GTA really wants to tax the Qatari shareholding or indirect Qatari shareholding? And what is actually the intention behind it, and how they will be enforcing it, because it is causing actually a lot of confusion in the Qatar market, that now the Qataris are, especially indirect Qatari shareholding, will become taxable, and whether there are any solutions available.
Maybe Imran, I will take this question because I think it will probably be the last question we can cover here. The other questions we will be happy to answer offline. So we have all the questions. We will come back to all of you where we were not able to answer the question. So on the indirect tax Qatari shareholding, the tax authorities were extremely clear in cases where you have not 100% Qatari ownership. So they were very clear on that. And I think the reason why it's basically, it goes back to how the law is drafted, which is not extremely good. And what they tried with the executive regulation is to fill the law with sense. And they go to a very, let's say, wording-based interpretation of the law. And if you read the law, yes, you can come to the conclusion that those cases is taxed. So yes, the answer is yes. They're very clear on that. where I see a little bit of more chances, and it was also in a meeting we had with the tax authorities, is on 100% Qatari owned, because there I don't really understand the reason behind, because you know, why should you be taxed only due to the fact that you have an indirect shareholding and not a direct one? So there I see a little bit more chances that the tax authorities will change their mind. However, you know, their first feedback was, even in those cases, they want to tax. And, you know, if this should really be the case, then what Seville mentioned before, probably the only solution would be to review the structures and see whether you really need a lot of intermediate holding companies. But here, the discussions is not really finished. Thank you.
Yeah. So we can end here. Probably we received a lot of questions, but we can answer those offline, or you can share through emails those questions.
Yes, so with that, I would really like to thank all participants, and also, you know, a lot for all those questions you have asked. Again, we will try to answer them after this webcast, so we'll come back to you. Thanks a lot, and let's keep in contact, stay safe, and hope that you will join another of our webinars soon. Thank you. Bye.
Thank you.